In this recording, we're going to look at problem 6 in chapter 12 and look at, specifically, we'll look at a variety of intangibles, and particularly goodwill. So as we read through, here's the narrative. You can read through it with me as you look at the screen. We have Montana Mats Golf Incorporated was formed on July 1. Notice it's 2013 when Matt purchased the golf company. And then Old Master provides video golf instruction at kiosks and shopping malls. And he plans to integrate the business into his golf equipment and accessory stores. Okay, so we can see he paid $770,000 for this business. And the business that he bought on that business's balance sheet had assets at $650, liabilities at $200,000, and of course that leaves owner's equity of $450. And again, that's book value of those items. Now it also gives us the fair value, which is more relevant to us, of $800,000. And then it tells us within that $800,000 there's a couple of intangible assets that it can identify. There's a trade name, and then also there's a copyright, and it gives us the fair value. And it tells us, you know, the trade name, whether it has a remaining life, and et cetera, et cetera. We'll come back to that here in just a little bit. But let's look at the purchase price of this business. So we can see that the fair value of these assets that Matt purchased, the fair value of those is $800,000. And then we want to subtract, look at that net, that's the fair value of the assets. We want to net out the liabilities that he also accepted when he acquired this business. And that business had, here we go, liabilities of $200,000. And of course, essentially those liabilities, their fair value and book value are going to be very close to be the same. Okay, so then we have a net assets, and so we have the fair value of the net assets to be $600,000. And again, that's going to be the fair value of those net assets. Okay, well, that's what he's acquiring, the fair value. So if he had just kind of bought those net assets separately, the purchase price, theoretically, would have been $600,000. But he actually paid for this entire business. If we go back up here, he was willing to pay $770,000. Well, why would he be willing to pay $770,000 when those net assets are really only worth $600,000? Well, there has to be some value in this business that he's buying, right? It could be the location, could be the quality of the products, it could be the excellent sales staff, and the reputation of the company. So this additional $170,000 is the extra he was willing to pay for that kind of intangible item of this business that he acquired. So again, whatever it is, reputation, quality of merchandise, even location, but it gives this business an advantage, and that $170,000 is called goodwill. That extra that he's willing to pay is goodwill. So when we get to the intangible assets section, one of the intangible assets that he bought is goodwill. And goodwill isn't, what, you and I sometimes think, it's not charity. In an accounting perspective, goodwill does not mean charity, like we may think of it in our personal lives. But in an accounting world, goodwill means that extra value for a company. Okay, well, let's look at the other two assets, because in this $800,000, it includes a trade name that he purchased, so trade name, and it tells us the fair value of that is $10,000. Fair value. Okay, and it also tells us that that trade name has a remaining life of 5 years, but it can be renewed indefinitely. So it's renewable. So in essence, that trade name has an indefinite life, right? Definite life. So they're going to be able to use that trade name indefinitely. Because of that, then we won't amortize it. So no amortization, because it's kind of like land, right? It's theoretically will exist forever, but not. We know realistically it won't exist forever, but in business terms, it's indefinite. The other asset, intangible asset, that's included in that $800,000 was the copyright. And that had a fair value of $24,000. And the copyright has a remaining life of 40 years. So it has a definite life of 40 years. So we are going to amortize that. So let's divide by 40 years. And we will get $600 a year. Now, did they have this copyright for the full year? Let's go up and check our date. No, they did not. This all happened in the middle of the year, July 1. So let's divide by 2 to get half a year's amortization. That'll be $300. Okay, so let's go put the trade name and the copyright up here. So we're going to have the trade name as an intangible asset of $10,000, no amortization for it. Likewise, we do not amortize goodwill. So goodwill and any intangible asset with an indefinite life, we do not amortize. So no amortization. However, the copyright does have a definite life. So we started with $24,000. Right, when we would have made our journal entry, there had been $24,000 in the copyright. We would have just amortized it at the end of the accounting period, $300. So that would reduce the book value down to $23,700. And again, we would have made journal entries for all three of these assets with our purchase price. When we paid the cash, right, cash would have gone out, and we would have debited various assets for $800,000, and included in those various assets would be the trade name, the copyright, and the goodwill. So those three would have been debited as part of the $800,000. Of course, there would have been other assets as well debited, and there would have been liabilities credited for $200,000. So again, we would have had, but we are only focusing on the three: the goodwill, the trade name, and the copyright. Okay, so if we add all of those up, we get $203,700 for total intangible assets. Now that's 2013. Let's go to the next part of this problem, and we're going to move forward to 2014. So, assuming nothing happens, we actually would have tested for impairment. This problem doesn't tell us that, but we would have done that, especially for the goodwill. That has to be done annually. So we would have tested for impairment, particularly for the goodwill, because we have to do that annually at least. There was no impairment. So in 2014, the narrative, because it ignores it, I have to assume there was no impairment. So let's go ahead and list these again. So goodwill, trade name, and copyright. So taking a peek, the goodwill and the trade name, we don't amortize those, so those keep the same amount, $170,000 and $10,000. Now the copyright, recall, we were down to $23,700. Amortization is $600 annually. So we're going to take the old book value, $23,700. We would have amortized $600, right? Debit amortization expense, credit the copyright, and that would take that balance down to $23,100. So let's add up our intangibles, and we get $203,100. So we went from 203,700 to 203,100. Okay, that's 2014. Let's go forward another year. So now we're going to be at 2015. And this problem really just asks us to solve for impairment. So we didn't have to, we need to assume that the test was done in 2014, at least for goodwill. And now in 2015, we have reason to think, the other two intangible assets, the trade names and the copyrights, might be impaired. So we're going to go through the test. So we're going to look at the copyright first. Recall it does have a limited life. So let's look at that one first. And then we'll go through the the trade name, and then the goodwill. Well, there's really a couple of tests for intangibles, and really they're the same tests as we saw for property, plant, and equipment back in Chapter 11, except they actually gave a name to the first one. So the first test is recoverability, and we're just taking those future cash flows, just like we did with property, plant, and equipment. So future cash flows, same we did with PP&E, property, plant, and equipment. So for the copyright, let's see, undiscounted. So undiscounted means the total future cash flows. That's going to be $30,000. So we just compare. We don't have to discount it back. Remember, it's a very kind of crude test. It's very lenient, very, very lenient. And we compare that with the book value. So here we need to go back, look at our book value. At the end of last year is $23,100, although another year has gone by. So it had, at the beginning of 2015, it was $23,100, but we would have amortized another $600 by the end of 2015. So it would have had a book value of $22,500, right? So we started with this in 2015, and of $23,100, and that would have gone down by $600, the amortization. So now we're at $22,500. Okay, we can see that the future cash flows exceeds that carrying value or the book value, so we can conclude that the copyright is not impaired. So we don't have to make, we don't have to solve for the loss and record any journal entry for that. Okay, let's look at the next one, the trade names. The trade names have an unlimited life. The unlimited life. Got a little crude there. So they have an unlimited life. So the rules will be a little bit different. First thing is, we don't have to solve for the recoverability test. And the reason being, because if you have an intangible with an unlimited life, it would never go beyond the recoverability test. It would always show that it's not impaired, because those future cash flows are indefinite. I mean, it goes on and on and on. That's going to be a huge number compared to carrying value or book value. So when the FASB came up with the rules for intangibles, if it's a limited life asset, intangible asset, the rules are just identical to property, plant, and equipment. So here again, the rules are identical to property, plant, and equipment if it has a limited life. But if it has an unlimited life, then we're not going to do that first test because it wouldn't make sense. So then we go to the fair value test, where we compare fair value. And so let's go to trade names, fair value, and keep in mind that could be a couple of different things. Fair value has those three layers. So the first one being, the market value of an identical asset. The second layer being the market value of a similar asset. So it wouldn't have to be identical, but something in the ballpark. And the third one, if we can't find market value, then we go look at data within the company. And often on these assets that are used in operations, often that's going to be the present value of those future cash flows. So it might be, that they took this $9,000 and discounted it back to the present to get this $3,000 fair value. Or it might be that, they were able to find number two, an asset with a similar asset. doubtful, but who knows, they could have. Okay, so the fair value test, we have $3,000 of fair value, and we just compare that with book value. So let's go back, take a peek. Book value has been $10,000. And we can see there's a loss, right? So we're going to go down here and make a journal entry, loss on impairment. And we'll put that $7,000 there. We also want to reduce the intangible asset, the trademark, by $7,000. So I'm going to credit that $7,000. And I'm going to hold off to make the debit in case goodwill also is impaired. If goodwill is impaired, we'll add that to our debit. So again, we're going to make a journal entry for the $7,000, and we know part of that is to reduce the trademark itself by $7,000. If we reduce book value by $7,000, then on the balance sheet we will have $3,000, which will represent fair value. By the way, let's go back up to the copyright. It was not impaired. So what's going to go forward to the balance sheet is that $22,500, its book value. So because the copyright was not impaired, we leave it alone at its book value. The trade names, that was impaired, so what will go forward to the balance sheet is fair value. Okay, and then the last one, goodwill. And again, we should test goodwill annually. It used to be, the old rules, that we amortize goodwill. But now we don't do that. The FASB changed the rules. We don't amortize it, but we are to test annually for impairment. Okay, well, here again, we're not going to have a recoverability test, but I'm actually going to need this space. I'm going to go ahead and put NA here, but I kind of need this space over here to write. The first step we're going to do is we're going to compare the future value of that business, excuse me, the fair value of the business that was acquired. So the fair value of that business, let's see, and that is going to be the fair value of the reporting unit, $420,000. So we can see $420,000. And then we're going to compare that with the book value of that entire unit that was acquired. And they even give us that to be book value $500,000. Okay, so this right now tells me, you know, the book value exceeds the fair value. So that tells me that there's impaired goodwill right there. And if this test had not been met, we would stop right here. So if, again, if the fair value had been $520,000, if the fair value had been $520,000, nothing would be impaired and we would stop and not go any further. However, that's not the case. So the second thing we're going to look at then is try to identify. They do give it to us. The implied value of the goodwill is $90,000, but I actually want to show you how they could actually arrive at that. So we have the fair value of the business is $420,000. Draw a line so you can see from 1 to step 2. Step 2, fair value of the business is $420,000. And then let's look at the fair value, or the book value of those net identifiable assets. So let's kind of go over here. We know book value was $500,000 for everything. So that's book value of everything. And let's go back. We also know, you know, the book value of the goodwill is $170,000, what we're carrying it. So there's our goodwill. And then, so the net is $300,000. $30,000 of the net assets. So if we exclude goodwill, the net assets excluding goodwill is $330,000. So here's our fair value. Here, here's the fair value of all the assets. Here's just the net assets, and so the difference is $90,000, and that's goodwill. Fair value of goodwill. And theoretically, that's how they got that $90,000. Okay, let's go to step 3 then. And we didn't, in this problem, we did not have to do step 2 because they gave it to us. I was just going on the tangent to show you how they got the 90. So we didn't actually have to solve for it. So the next thing then, we're just going to compare the fair value of goodwill is $90,000. But we have it on the books, remember, at 170. So we have a big loss, don't we, of $80,000. And so we need to make a journal entry for that $80,000 loss. So the goodwill only seems to be worth $90,000 at this point in time, but we have it in the accounting records at $170,000. So we want to write the goodwill down by $80,000. So I'm going to combine these two losses. So I'm going to take, this $7,000 loss and this $80,000 loss and combine them in my debit to $87,000. So then we credit the trademark for 7, and we credit to reduce goodwill also by its loss of $80,000. And there's our journal entry. Okay, so what's going to go forward for goodwill? If we had $170,000 in the account, we'll reduce it by 80. $90,000 will be left in the account, and that also represents fair value. Okay, I'm stepping back in. I paused for a moment, and I went back at the beginning of chapter 10. We had this handout, or these were some of the student materials. You might want to just pause your video and go get that. I'm going to use this as just a review for the chapter 10 through 11 exam. So again, feel free to pause, and then we're going to move forward. Okay, so getting started. The exam will be in Wiley Plus. It consists of 25 multiple choice and exercises. So, and you'll have 75 minutes for it. So I just want to point out, it's not really designed to be an open book test because it's pretty lengthy. 25 multiple choice and exercises. There's plenty of time to get that done if you know what you're doing. So it'll be 75 minutes long of going through that. As part of your review, I suggest you go through these topics. Again, this was in chapter, this one represented chapter 10 through 11, and then I gave you another one for chapter 12. Make sure you know these topics, and then, always rework homework. So study your homework, your assignments in Wiley Plus. If you've printed those out, just go over those and make sure you could work those. The other thing I would suggest in Wiley Plus is the study guide. The study guides chapter by chapter. Not so much that you want to read those outlines, although you certainly could. It does outline the chapters for you, but it's helpful because there are multiple choice questions in there with answers. There are little exercises in there with answers. So it could, the advantage of it is that it could put you in an exam mode. Notice I'm using multiple choice and exercises. That's what you'd see in the study guide. So you can kind of use that as a practice test. And I have not looked at those study guides specifically as I planned the exam. It's not like I looked at the study guide and modeled the test after it. I did not. So I'm not suggesting that everything, the study guide covers everything, but I think there is some sample stuff in there that would be very useful. Okay, just quick review. Know the characteristics of property, plant, and equipment. know about the historical cost, and if so if cash is paid, that's easy. But if cash is not paid, then you're trying to look for cash equivalent price, and and then trying to figure out, well, what is that cash equivalent price? So then we might have to look at fair value. So going back to chapter 2, is it fair value of identical asset, like stock sold on the publicly traded on a stock exchange? That would be an identical asset, although that's not property, plant, and equipment, but still. Or is it a similar asset? If we have a used piece of equipment and there's a used market, could I find a similar asset and use its fair value or market value? And 3 would be some internal data. And what we have seen in these chapters 10, 11, and 12 is that going to be taking the present value of those expected future cash flows. And we do that because these assets are used in operations to generate revenue. Revenue is going to result in cash coming in. So it makes sense to do that. We can look at how much cash is going to come in the future, discount that back to the present by assuming some interest rate, and we have a value. Okay, if there's been an inefficiency, so if we drop something, so I buy a computer and I drop it on my way to my office, I'm not going to capitalize the cost of that computer. If I have to go back out and buy another one, I'll capitalize the cost of the second computer. The first computer becomes an expense. So inefficiencies or unnecessary activities, we don't capitalize those because a capital expenditure provides future benefits. Cost principle. In general, all costs to acquire and get that asset ready for its intended purpose. So here we've listed out and we've gone through all the typical ones for property, plant, not all of them, but here are some examples of typical ones for property, plant, and equipment. For land, remember, if we demolish the building and we salvage some of that, sell some of it off, that's going to reduce our costs. And then here's typical costs for land. So going through all of those, remember land's not depreciated, and if we improve the land, like, construct a road on top of that, that has a limited life, and we would depreciate those land improvements. So land improvements are an asset, a depreciable asset. Interest. If we borrow money to construct an asset, we capitalize it as long as 3 conditions. We're making expenditures to construct the asset. Activities are in progress to get the asset ready, but it's not ready yet. And we're incurring interest. And so we've gone through that, and again, you'll see that in the homework. But again, up until we actually start using the asset, if here we start using the asset, we can capitalize interest all along. Not all the interest, there's a formula for that, but we can capitalize this interest until we start using it. Lump sum purchases, we actually saw this back when we were studying inventory. If we buy several assets write one check, how do I assign the cost to asset A, asset B, asset C? Cash discounts, really doesn't matter. Either way, cash discounts are going to reduce cost, right? That's what a discount is. It reduces our cost, our purchase price. How we account for that, it depends. But either way, it's going to reduce our property, plant, and equipment. And again, we saw these with when we're accounting for inventory. Again, we're same concepts when studying inventory. If we donate property, plant, and equipment, if we're receiving it, we record it at the fair value, and so we would debit the asset, credit contributed revenue. If we're giving it up, we get to expense it with the whole fair value, remove book value, and the difference is a gain or loss. If we exchange debt for equity, here if we're going to record the new asset at either the fair value, either its fair value or the fair value of what's given up, depends on which is more reliable. So you have to think through which fair value is more reliable, and that's going to get you back to these 3 layers, right? Level 1 is most reliable, level 2 not as reliable, but it's more reliable than level 3. So breaking out, determining which fair value would I use. Fair value of debt is the present value of those future cash flows. Fair value of the equity would be the stock market price of the stock if it's publicly traded. If it's not publicly traded, it's hard to arrive at a market price then that is objective. Exchange of non-monetary assets, it kind of depends. It depends on whether there's commercial or non-commercial substance. Whether we recognize, in all cases, losses are recognized either way, commercial or non-commercial. It's the gains that vary whether we recognize the gain or not. If it's commercial, we will recognize the gain. If it does not have commercial substance, we may not recognize any of the gain, or we may recognize part of it. So you want to go back to those rules. During the use of the asset, so once we start using it, we're going to spend money on it, right? We'll have some expenditures. And so the big question is, do we capitalize those or expense them? We capitalize them if they provide, future benefits. Here were the three things that we went over. The useful life can be increased. The quantity of units that the asset will produce will increase. So if we have a copy machine and we spend some money on it, and it will increase the number of copies produced in the future from what we originally expected, then we would capitalize that cost. Okay, and then the quality is enhanced. So we expense it if we don't have future benefits. That's what happens. The large majority of expenditures are expenses. And so you can go over the rules there on that particular page. Depreciation, accelerated versus straight line. This was a big issue, and I mostly used the mix-max case to demonstrate this. But you should know, what difference, whether we use an accelerated method, what difference does that have on profits? And what difference does that have on our cash flow? And really, when I say cash flow, I mean income tax paid. Income taxes paid. So go back to your mix-max and make sure that you understand and can solve for, what would the difference in profit be, and what would be the difference in cash flow, which really is asking, what's the difference in the income taxes paid? Disposal, this is kind of easy. Record your depreciation up to date. So we need to update the asset, and then there is just recording the disposal. Cash comes in, we get rid of anything in the accounting records, the book value, both accumulated depreciation and the asset itself, and the difference is a gain or loss. Okay, let's go over now and look at Chapter 12. Okay, so then we move to Chapter 12, Intangible Assets. So again, they're going to be long-term, but now they lack physical substance. And also, they are not financial instruments. So, any of these bank accounts or receivables, or we have long-term investments, none of those actually are intangible. They don't have a physical substance, but they are not going to get categorized as intangibles. Intangibles usually mean some intellectual right, usually. So at acquisition, it depends whether we buy it outright or we internally develop it. So the accounting rules depend. If we internally develop it, we don't know at the time we spend the money whether it has a long-term benefit. So the FASB said, just expense it all. So research and development, those costs spent on researching and developing an intangible asset, we just expense it outright. The only exception is if there's R&D expenditures for property, plant, and equipment that have alternative future uses, either for future R&D projects or otherwise. And we can see, in essence, this really violates, the whole idea of relevance. It would be relevant, really, to know, of these R&D, which ones of those actually have long-term benefits. If we could discern that, it would be helpful. And, also faithful representation. So those really are violated. But the reality is, it's just a practical rule, because at the time the money is spent, usually we don't really know. But here's the thing, remember in the homework, it didn't matter even at the time if we knew. The FASB just says expense all R&D. Okay, so if it's internally developed, essentially that gets expensed if it's in the research and development phase, if it's in the R&D phase. If we purchase it outright, we apply the cost principle, all costs to acquire, and get it ready for its intended purpose. So that usually includes those particular costs. And then, all of this really is just it's the same cost principle we went over with inventory. It's the same cost principle we went over with property, plant, and equipment. going on during the use. We might spend money. Typically, those are defending, like a patent or a copyright with a lawsuit. So the question is, do we expense it or capitalize it? Well, if we successfully defend the patent or copyright in a lawsuit, we will capitalize it because that provides future benefits. But if it is not successfully defended, then we don't capitalize it. We will amortize intangible assets if they have a limited life. If they have a limited life. If they have an indefinite life, we do not amortize them. And also, just customary, we do not use an accumulated amortization account. We credit the asset itself. Then impairments, we just went over that earlier in this recording. It depends if they have a limited life or an indefinite life, other than goodwill, or whether it is goodwill. And we've just gone over all of those tests. The recoverability, if it has a limited life, the impairment rules are identical with property, plant, and equipment. It has an indefinite life. We skip the recoverability test and just move on to the fair value test. If it's goodwill, we do the fair value test on the reporting unit as a whole first. And then if that set indicates that there's been impairment, then we do the fair value test on the implied goodwill. And lastly, notice testing goodwill is required annually. All right, and then that's it. All right, so study well for this test. It's nice because it's really one unit, that all long-term assets, so it connects really well together. I would suggest, as you're studying, that part of your studying would be that, okay, you can see I quickly sneaked back over here, but part of your studying, I would suggest, and your preparation for this exam, is just create a study sheet for yourself. I would suggest you go beyond, either you need to mark up your book really well and have it tagged in case you need to quickly look something up, but really that's probably going to be too time consuming for this test. I really would suggest that you just create a study sheet for yourself, and and whether you want to use these outlines and just supplement, make little notes on it if you want. You're welcome to do that, of course, but and just have that ready when you take the test. That will relieve some of the anxiety, so it's not an actually closed book test and you're just not going in blind. But you have a little bit of study sheet and thing in case you kind of forget a little rule and you need to look it up as something real quick. But you need to have something really handy because, again, this is not designed to be a truly leisurely open book test. It's meant to test what you know right now, but again, giving you the option of having a little study sheet that you put together for yourself so that you might kind of glance at it now and then if need be. But there will not be time to go back to a book and read anything. There's just not that kind of time designed in the test. Okay? All right, well, good luck. I think you'll find the test it covers just about everything. It will cover, really, just everything. Everything that's on here is on the test one way or another. But I think you'll find it's pretty straightforward. So it's very comprehensive and detailed, but it's straightforward about that. Some of the tricky things we see in the homework won't be there on the test. It's going to be more upfront, obviously because it's short, multiple choice and exercises. Okay? All right, good luck to you.